Welcome to this explainer. Today, we're unpacking a massive, truly fascinating financial paradox that's happening right now at one of the world's biggest tech titans. We're talking about JD.com. They're heading into their absolutely crucial May 12th earnings report, and honestly, the setup is easily one of the most compelling business stories of the entire year. What we have here is a classic showdown between undeniable, massive operational scale and a fiercely expensive turf war.
So, here is the central mystery we're going to solve today. How does a global e-commerce titan, a company that literally only trails Alibaba and Pinduoduo in China, achieve its absolute biggest year ever in terms of sales, moving more goods than some entire countries, while simultaneously draining its profits? It feels like a total contradiction, right? I mean, you'd naturally think record sales mean record profits. But in the hyper-competitive, cutthroat landscape of Chinese tech, the reality is way more complex.
Let's start with the first signal of this paradox. $185 billion. That is JD.com's massive fiscal year 2025 record revenue. It's up 13% year over year. That puts JD firmly in the global top 10 e-commerce companies, standing shoulder to shoulder with giants like Amazon. It's just a staggering amount of volume moving through their system. By all traditional metrics, this is a company firing on absolutely all cylinders at an incredible scale.
But then, you get the visual whiplash, negative 51%. Despite pulling in that colossal $185 billion, Wall Street consensus actually expects their Q1 2026 adjusted earnings per share to plummet by 51% year over year, dropping to just 55 to 57 cents. So what on earth is devouring all that profit? Well, to understand the bleed, we first have to understand exactly how JD makes its money and, more importantly, how it operates.
Okay, let's dive into this. Section 1. The self-operated engine. We really need to look at the foundational business model that makes JD entirely unique in its market. It's what analysts call the self-operated engine. See, JD operates on what's known as a 1P or first-party model. This basically means it's a completely self-operated inventory system. JD actually goes out, buys and owns the products they sell. They run the massive warehousing network themselves, and they employ the actual riders who do the last-mile delivery. They control the entire heavy, super capital-intensive pipeline from the exact moment a product enters a warehouse to the moment it arrives right at your doorstep.
This is totally unlike Alibaba, which primarily uses a 3P marketplace model, acting essentially as a digital landlord, renting out space to other merchants, or Pinduoduo, which relies on a really asset-light social commerce model, competing relentlessly on price. JD's 1P model gives them a massive structural advantage, a massive trust moat. Because they own the pipeline, JD can guarantee product authenticity, enforce super strict quality standards, and offer literally the fastest delivery network in China. For them, same-day or next-day delivery isn't some premium perk. It's just the baseline.
However, that massive trust moat comes with some incredibly heavy chains. The 1P model ties up just massive amounts of working capital. If a product doesn't sell, JD eats the cost. That's a huge inventory write-down risk. Furthermore, this heavy model makes them highly vulnerable to current macroeconomic headwinds in China. With elevated youth unemployment and a property market overhang compressing household balance sheets, consumer spending has really stagnated. JD's Q4 2025 revenue growth slowed to a crawl at just 1.5%. Add in the fact that JD proudly employs full-time delivery riders with formal labor protections, and you've got a model that is incredibly expensive to run day to day.
Section 2. The instant retail war. Which brings us to the very bleeding edge of their profit margins. It is time to talk about the brutal turf war actively draining JD's earnings. This number right here is the culprit. That is $1.4 billion with a B, just to seed its food delivery business. They're essentially paying people to eat, literally buying their way into a new market and subsidizing orders so aggressively that it hits their profit and loss statement immediately, long before the revenue can even hope to catch up. It is a massive, highly capitalized gamble.
Now, what's really interesting about this slide is the current state of the battlefield. It's a classic David and Goliath story. The incumbent giant, Meituan, absolutely dominates with roughly 65% of the instant retail market. JD is the scrappy underdog here, currently carving out about a 10% slice, with others holding the remaining 25%. JD is taking on a Goliath, and they're doing it by challenging Meituan not just in delivery, but even launching things like JD Review, a non-commercialized rating platform designed specifically to challenge Meituan's monopoly on restaurant reviews.
And here is why Wall Street is so deeply divided on this strategy. Despite the intense cash burn, JD's aggressive, expensive strategy is actually working. They're processing 20 million orders per day in this segment. Analysts had projected that if JD could reach a 10% market share by 2030, they'd finally hit a profitability inflection point. Well, JD effectively hit that milestone more than 2 years ahead of schedule. They've captured that 10% in less than 12 months.
But, as we all know, explosive growth triggers explosive responses. The primary threat right now is massive retaliation. Meituan has the capital, the operational scale, and the consumer mindshare to fight back with aggressive counter-subsidies of their own. Meanwhile, Alibaba-backed LA.E is making its own defensive moves. The grave danger for JD here is that their $1.4 billion 12-month investment suddenly devolves into a grueling, multi-year cash burn that just keeps their EPS totally compressed for the foreseeable future.
Let's move to and see how this builds. Section 3, the logistics juggernaut.
Now, JD isn't just fighting a war of attrition. They actually have a massive structural defense supporting them. While the food delivery war is burning through cash, JD Logistics is quietly acting as a true structural compounder. In fiscal year 2025, JD Logistics actually grew faster than its parent company, surging 18.8% year over year to reach an absolutely incredible 217 billion renminbi. This is widely considered the most underappreciated asset in the entire JD.com group.
The real secret weapon behind this growth is their proprietary LangzuTech automated warehouse platform. And guys, this isn't just a few conveyor belts. This is self-developed, cutting-edge automation IP. We are talking about hundreds of robots swarming around per facility, creating dramatically faster picking and outbound efficiency that absolutely crushes traditional manual operations. And they've successfully deployed this system across over 20 facilities in nearly 20 different Chinese cities. It's phenomenal.
And the craziest part? They aren't stopping at the Chinese border. JD Logistics is monetizing this automation IP globally. In Q4 2025, they launched their very first overseas LangzuTech automated warehouse in the United Kingdom. They're taking this IP worldwide, now operating facilities in the US, France, Poland, South Korea, Vietnam, and Saudi Arabia. This is just a brilliant strategic move, targeting the $400 billion global e-commerce logistics market, offering high defensibility growth, rather than trying to directly fight Amazon for retail consumers in mature markets.
Section 4, stakes for May 12.
All of these powerful forces, the record retail revenues, the massive food delivery cash burn, the explosive logistics growth, they all collide on Tuesday, May 12th. Here's the baseline Wall Street is expecting for the Q1 2026 print. They're projecting roughly $45.15 billion in revenue, which is a very healthy 9.84% jump year over year. And overall, analysts actually have a buy rating on the stock with a price target of around $40. However, that buy rating hides a massive amount of disagreement among investors about exactly how quickly JD can normalize its profit margins.
So, the crucial point on May 12th is which of these two scenarios proves true. The bull case hopes to see Q1 revenue growth above 9%. Clear signals that 2026 is the absolute bottom for the EPS trough, and accelerated overseas expansion. But on the flip side, the bear case is terrified that Q1 revenue growth might dip below 5%, that the subsidy spend is completely exceeding plans, and that Meituan's relentless retaliation will extend this painful burn timeline indefinitely.
And that leads us to the ultimate question you should take away from this explainer today. Is that 10% and growing instant retail market share actually worth the brutal 51% margin compression we are seeing right now? The May 12th earnings report will be the most critical checkpoint yet to see if JD's massive gamble is a stroke of visionary genius or a wildly costly misstep into Meituan's territory. Definitely keep a close eye on those numbers on Tuesday. Thank you so much for joining me, and keep learning.